Michael, let's start with the sell-off that we saw in the markets. Fairly deep, big plunge. I mean, the Wall Street Journal, I know, had a headline. They were talking about, trade anxiety and economic growth anxiety. What happened yesterday?
I think it was a confluence of a few things. Expectations for the optimism after G20 faded after people started looking at the details. There has been a tremendous short in the bond market that got unwound yesterday, so bonds rallied amazingly. And broadly speaking, there's a lot of systematic selling yesterday that just overwhelmed the brokerage industry. So nothing really, there's no economic data that came out yesterday that would support this. It's very much one of those random sell-offs, and it's really in tune with what we've been witnessing over the last few months, where we've had a lot of volatility, but broadly speaking, stock markets haven't really gone anywhere. I mean, they're certainly off the highs, but I think we were chatting a few months back, and I think we're about 50 points higher today than we were then. So not exactly a pleasurable experience, far more volatility than return, but not unexpected in a kind of global growth slowdown.
I guess, and that's probably, I think, the big concern people have is that, the G20 happened, people were feeling, I would say great, but okay. And then you get some tweets from the president that seem antagonistic, talking about tariffs and those types of things. So should we just expect there to be this kind of volatility going forward based on this 90-day ceasefire between the U.S. and China?
Yeah, so there's two things I think one that really matters and one that's a much longer story. The U.S.-Chinese trade tensions is not going away. It's not going away in 90 days. It's not going away next year. This is a very, very complex negotiation that spans various types of technology, growth aspirations, et cetera. And so this will be with us for some time. But on the more here and now, our work would have suggested that in September we started to see a slowdown in global growth. That has played out in various markets. And what you've seen now is starting to see responses from various central banks. So last week, Powell was speaking and really walked back expectations for hikes next year. So now we're actually only pricing in 2 hikes for the next 12 months in the U.S. Today, Bank of Canada, also, who was very hawkish in October, now have walked that all back and been very dovish. And we're only pricing, I think, sub 2 hikes for next year, and I would say probably just 1. And so the central banks have reacted to this slower growth by bringing back expectations for hikes, which will mean easier financial conditions and ultimately will be supportive for equities over the next 12 months.
So what do you do moving forward? I mean, how are you seeing the markets as we move forward then?
So short term, we're able to get cautious. We've certainly been looking at ways to ultimately invest in this range. And we're going to see how this bottoms. Ultimately, we want to see a bottoming of growth expectations before we get bullish again. So we've really dialed back our risk somewhat. The nice thing from my perspective is that earlier this year we saw both bonds and equities selling off, which is a very challenging environment. Now at least we're starting to see some diversification come back, where days when the stock market sells off, the bond market rallies. For example, yesterday bonds were up anywhere from 50 cents to 1%. So a much better environment for bond investors.
Michael, thank you.